Today I want us to talk about fair value gaps. Yesterday we talked about other blocks, and one thing I want to first of all let you know before we go deeper into trading is that real trading is not trying to find setups in every move in the market. Real trading is being patient, sitting on your hands. I think maybe if you have watched the video that I put out on YouTube today about Livermore, it's one of the best videos that I've ever heard. Or with like what I'm actually trying to say is when I'm patient, that's when I make the most amount of money. When I'm patient. But if I'm not patient, like I get up in the morning, I'm just sitting on the charts, like trying to force a trade. At the end of the day, I tend to make more losses rather than profit. So at the end of the day, I will not instead make more money. Now, like for example, this morning on Euro USD, the time that I was recording that video, I noticed something here. This was an Asian low. Okay, price. I knew that price was going to take this Asian low, but now, just from here, if you were someone that is so trying to force trades in the market, maybe you would have started with this, that okay, this is another block, price will respect this one, because this was already London session. As of this point, we're already in London session. You put your stops like that, and then you're targeting higher prices, and then you get stopped out. You want to force again to this other block. You're looking at again that this candle, that all right, this should be the next other block, price should respect this one, and then you get stopped out again. Now, with all these trades, maybe because they have this another break of structure here, and this another break of structure. Now we're going to talk about break of structure. Like this one here is not actually a valid break of structure. When you get a break of structure with volume, it's that's the kind of structure that shows intentions of really moving in the opposite direction. But this one is just a structure shift that is like a turtle soup or stop horns actually. Now what I'm trying to say is that looking at this price action, even if we try to go maybe to the 1 hour chart, we don't really see anything very interesting here, right? We don't see anything interesting at this point. And there's basically no bearish PD array that price had failed to respect here, because as far as we can see from this high and then this fair value gap, price has not invalidated any bearish resistance zone, as I can put it, or any bearish PD array. So if you looking at the 1 hour time frame, like I always emphasize, that you start looking at it from the high time frame perspective, you will not see any reason to maybe start forcing in some buys here, because the market is still bearish. But now, this is not actually the main reason, because sometimes you can have price can start buying from here. Now I will explain why price did not buy. It was because we had a drawn liquidity on DXY, which is this high right here, this one. Price has not tapped that yet, and if it has not tapped, then you keep playing with Euro USD like that. I think I also mentioned that on the video as well. This is also an inversion gap here, and I believe that price has to maybe pull up to that area. Let me try to put this. Price is going to trade up into that zone, also taking out this high. Now, since Euro USD and DXY are correlated, it is very important that we wait to see DXY start to get, because for Euro USD to buy, DXY has to be weak, right? But now, if DXY is pushing higher, it actually means that DXY is stronger. And if DXY is strong, and we know that it's definitely coming up to this high, therefore, Euro USD should not be buying as well. So which means Euro has to be selling more. Why I'm saying this is because when you look at Euro USD, price have actually taken out also a low here. Price have taken out this low. All right. So a lot of people would have expected that maybe price should push higher, but that was not the case. And even this is still a low here that has not been taken out as well. So we are still very much bearish. Okay. what I'm saying is based on the patience level. If you are not patient enough to maybe even wait at least to see price give you a clear structure, maybe from the 4-hour chart, you will not know what you're doing, right? But for example here, if we know that we are buried, therefore we should be looking for more sales, right? We should be looking for more sales, especially on this FVG. We should have been expecting price to sell more instead. Now, price tapped into the 4-hour FVG, and then we had price closing below this bullish candle here, which is a model 1 entry. We'll talk about when we'll start talking about CRT. But now, what I'm simply saying is a lot of people try to force in a lot of buys here. I will say that first because there is no reason for price to just start buying like that on the higher time frame. We don't see any basic key level that price has tapped into on the higher time frame. We still see liquidity areas that price is trying to clear to the downside. Maybe if we would have cleared it also here, coming down to this inversion, we might now be expecting price to pull back higher. So now, what is the point I'm making? The point I'm making is patience. The more you're patient to wait for the market to deliver price, that's the time you're going to get more profitable setups. Allow things to become simple, because if I should be going back like this, I'm going to see a lot of clean price action. I'll be seeing how price is respecting areas just very nice like that. But now, when it comes to the timing, or when it comes to the current time of price, what is going to happen is that I'm going to be looking at candlesticks, trying to force the moves and stuff like that. At the end of the day, I'll get more losses than wins. But now let's look at this first fair value gap here. Let me change the color. Let's use this one. And let's say we'll go down to 15 minutes. Now, because we want to be on a trade and we don't want to be patient, what we're simply going to do is start considering this to be a break of structure, and then start considering this to be a bullish order block, a block to buy and price to go higher. To where? That's the thing. So we are not patient and we're not following the higher time frame direction. So those are the things that you have to consider. Patience. Patience is the key thing that you have to focus on here. Patience is where the real money will come from, when you are not rushing after setups. That's why scalpers, you hardly see profitable scalpers, because the moment you are rushing like that, that's not the right approach to making well. With so much rushed like that, no, it doesn't work most of the time like that, unless, because first, if you even with ICT, who trades the second chart, if you watch his mentorship, you will see him talking about swing traders, position traders, strategies for them to use. So which means that you already have a clear understanding of what you're doing. You already know how to trade all time frames before you can decide now to do what? Bring it down to the lower time frame, because price is fractal, which means that if we're seeing this happening on the 4-hour chart, we see price respecting a fair value gap on the 4-hour to move lower. This could have been the 5-minute chart, could be the 1 minute, could be the second chart. These are just candles, and we understand them based on PDR. The thing is just that if this is the 5-minute chart, then this would have happened in just a couple of minutes, right? But since it is on the 4-hour, it took maybe a whole day now to play out. But if it was on the lower time frame, like maybe 1 minute, it wouldn't have taken us maybe even up to an hour. Like this would be one minute candles and stuff like that. So that's just the difference. So like I said, today we're talking about FVGs, and I think since from the start we have already been trying to talk about it, but not really in depth form. Now, I just want to make it as something very simple. When we are talking about fair value gaps, it is simply just price volume that we're trying to measure, or an imbalance in price delivery. This imbalance is always caused by the volume of price. Okay, this imbalance is caused by the volume of price, and it's always mostly in between a three candle pattern, where we have candle 1, where we have candle 1, we have candle 2, we have candle 3. Okay, this is where we have our fair value gap. Our fair value gap is the low of this bullish candle, the high of this bearish candle. Sorry, the low of this bearish candle and the low of this one. When they don't intersect, that's where we have the imbalance. It actually means that the buying pressure that came in from this particular hour of this candle, buyers were not able to push price right up to where they got in on the previous session. When that happens, we see that there is an imbalance between price delivery. And the reason behind this is because of volume. Volume here means the amount of orders coming into the market. It's just like, for example, we have, because we know that for the market to move efficiently, we need to have buyers and sellers. So if buyers here are about 100 and we have just 50 sellers, if we have just 50 sellers and we have 100 buyers, what is going to happen here is that buyers are going to be overthrowing the sellers, and in this case, prices are going to be rising in a very heavy way, or with too much volume, because there is too much demand for that particular asset. It's just like if, let's say, for example, the iPhone 17 that just came out, if we could say that maybe it's only 10 there are only 10 of them in the entire world, do you think the price would just be around $1,000? No, it would be far more than that. The thing is, when you create something of value and then they are limited in stock, let's say maybe you invent a car, let's just say like the Tesla, all right, let's just say like the Tesla, and then in the entire world they have just five of them, limited like that. Now this is going to cause the price of this to rise, because there are going to be a lot of people interested in it. And because a lot of people are interested in it, you're not going to be giving it out just for free money like that. No, a real person will put in a lot of will put a price tag to it that is also much, because a lot of people are interested. And that is exact same thing that is happening here. When more people are selling an asset and buyers are trying to push price higher, but they are not able, it causes these FVGs, it causes this imbalance in price delivery. And for the market to move efficiently, what happens is the market subsequently will come back to rebalance these areas. Okay, maybe in the next candle, we're going to see now a bullish candle. Will see price doing what? The market might open here like this, and then on this candle we trade up to this area of the fair value gap, and then maybe now price will do what? You can now continue back to the downside like that. Now what has happened here is that price has traded back into an area where buyers were not able to trade into. You understand? Now let's look at this scenario. It is buyers who came in at this price point and were able to push price back up to close at this candle, because this is a bearish candle. So which means that when sellers push price, it reached at this point, and then buyers came in and pushed price up. Now when the candle closed and the next one opened, sellers took over again, went down, and then could not. Buyers came in again here, pushed price up, and the candle closed. The next one opened, buyers came in, pushed price again, and then it ended just at this point. So if this means that there are some particular figures here that the price difference between this point and this point is that buyers did not bargain. Buyers were not able to bargain price in between this area. So that's an imbalance in the market, which means the market was not actually balanced at that particular point. Are you on the? So it is very, very important to understand the theory of this before you start looking at how to trade these candles, all right, or these FVGs. Now, most importantly, remember the phase of our analysis. We are already talking about, we are on phase 2, which is about support and resistance, right? Now, at this point also, we use fair value gaps in 2 ways. The first is we use a fair value gap on the higher time frame, as a key level. We use it on the lower time frame as an entry. We use it on the lower time frame as an entry. We use it on the higher time frame as a key level or a draw on liquidity. And then we use it on the lower time frame as an entry. Now, on the higher time frame, it is where price will likely trade into and start reversing, because price will come to rebalance and then to continue back lower. Also, if let's say, for example, price creates a swing like this on the daily chart, and now we have a fair value gap here. Now, price might take about 5 days to come back up to this point. So, which means that this FVG here is actually our draw on liquidity. So at the meantime, we're going to have price pushing up to this point to rebalance this area. So if we have price sitting here, then this area is our draw on liquidity. This area is our draw on liquidity. But now on the lower time frame, if price comes to this point and it's supposed to sell back lower, now the price gap between this point might be about 100 pips or maybe 150 pips and stuff like that. Maybe the gap difference, right? But now on the lower time frame, the gap difference is just going to maybe be like 10 pips. So since we know that price will come to this point and continue selling, but if this was the lower time frame, we can actually take the sell the moment price comes to this point to expect it to go lower. Why? Because the peak value is not going to be high. But we're going to look at some examples. All right. So remember I said, if you are looking at an FVG on the higher time frame, what you're looking at is trying to get a key level or a draw on liquidity on the higher time frame. You are looking at a draw on liquidity on the higher time frame. Let me use this asset. Let's use US 100 or gold. Let's use gold. Wow, gold has straight right up to 4,000. I think we talked about this price figure. Was it a couple of days back? Now, remove this. So when you're looking at FVGs on the high time frame, because this is the weekly, then what we are looking for is key levels. This is a fair value gap that we have here. Price came into it and then started buying. Now we have another one here. You're also going to notice that you have some FVGs that price would maybe not come down to. Like for example, this one. It's just like you have key levels on your chart. Price must not come to all the key levels on the chart. Now, also, a tip is when you have a key level that has to do with another block, or you have a fair value gap that has another block around it, that increases the chances of that fair value gap for price to rebalance. Just like this one, when price is bullish, every bearish down close candle becomes a support, and it's another block, then it confluences with a fair value gap. It makes it more stronger. The same with this one. We have a down close candle with a fair value gap above it. This actually shows that the volume that was inputted into this bearish movement for price to continue higher was much. That's the volume that we can see from there. Now, like for example, here we see a couple of FVGs, price has not actually traded back into it. Now, in an area like this is called an imbalanced price range, right? You don't just call it maybe a fair value gap, there are a series of them. So this now it's an imbalanced price range, okay? It is an imbalanced price range. A fair value gap will just call this is a fair value gap. I mean, there are fair value gaps inside, but as it's a big range, it's now a balanced price range. Now, an imbalanced price range. Now, what I'm trying to explain is we have these FVGs that price has respected right from this point upward. We use them as key level. They act like they're going to, bullish fair value gap is acting like a support, and a bullish fair value gap is called a BC. Maybe you have seen that I write on my this thing, a BC. All right, a BC is buy imbalance, sell side inefficiency. Should put that down. Buy side imbalance, sell side inefficiency. That's a BC. It's a fair value gap that is on the buy side. All right, that is going to support price to continue higher. It's a fair value gap that is on the sell side is called a CB, which is sell side imbalance, buy side inefficiency. Okay, that's just to differentiate it. Like this is a CB, and then if price is supposed to be selling and it's creating those imbalances of fair value gaps, they're going to be called CBs. Okay. Now, what we are doing here is simple. We are marking out these areas of FVGs to use them as key levels for price to continue pushing to the upside. But now, it will step down to the lower time frame as of this point. Now you will notice that the market took a couple of days to come back to this one. That simply means that if we started seeing price dropping, they would have been targeting the fair value gap on the daily now, on the week, on the higher time frame as our drawn liquidity. Also, just exactly the same thing here. When the market started dropping lower, we would have noticed that okay, price is coming to rebalance that internal range liquidity, which is the fair value gap. For these 3 bearish days, would have been targeting that FG. Why I'm saying this is because maybe for these 3 days you are not just supposed to be sitting, right? You could be selling this pullback, knowing that price is being drawn to a fair value gap on the daily chart. It's the same thing here. Now, when price comes into the fair value gap, what happens? You now shift from trading it as a drawn liquidity now into a key level. All right. When the price was still reversing from this point, this was a draw on liquidity. But when price comes into it, now it's a key level. And a key level, it is zone where we go into it to wait for price confirmation on the lower time frame to get longs or to take trades in the direction of the trend. All right. So when price is still up here, this is a drawn liquidity. When price comes down to it, it becomes a key level. And now this key level, we're now looking to take positions. We're looking for confirmation now to be able to buy. Why are we looking for confirmation? Because these 3 bearish days, if we move down to the lower time frame, what we're going to see here is we're going to see a downtrend on the lower time frame, because just a single candle like this one, just a single candle like this, a single bearish candle like this one, when you go to the 1 hour chart, you're going to see it like this. You're going to see that the candle is a downtrend, right? It's going to be a downtrend. So this couple of days here, we have price pulling down. The price is on a downtrend. So when it approaches this key level, we know that we are not supposed to be doing what? We are not supposed to be buying on a downtrend. So what we are waiting for, as we say that this is a key level, we want to wait for price to shift to an uptrend before we will be interested in trying to buy at that time. Why? Because we are now buying in an uptrend, which is buying at this move that is happening here. That's the difference, right? So on the higher time frame, we're using these key levels as, we're using these FVGs as what? Fair value, as key levels and drawn liquidity. But on the lower time frames, maybe like one hour chart or more lower time frames, where we're using where we're going to be using this as entries. Let's see, for example, we have let's look at this one, for example. I think this was the FVG on the weekly where price came back to it. Okay, now what did we see? This is a downtrend into that FVG, and when price came into the FVG, what happened? We had a shift in market structure, which means that this downtrend has ended. And now you identify, if we now identify an FVG, if we now identify an FVG here, we are not going to treat this FVG now as a key level again. No, we're going to treat it now as an entry. Why? Because the PIB range that we have here now is not that huge. Like, for example, if we wanted to treat, let's quickly measure this thing. If we wanted to use, I want us to measure something here. Okay. Now, this is the fair value gap on the weekly, and it's about 200 points. 200 points. And now on the 1 hour chart, we have the same FVG. We have the same FVG. We have the same FVG for how many points? How many pips? Let's see. We have the same FVG for about just seven points here. So it is different now, right? The higher time frame, has quite a big zone, but now on the lower time frame, for using it as an entry, it reduces. Now, why we don't just want to use the higher time frame as an entry is because we don't know how deep price will be on inside the fair value gap, right? Like for example, if we would have just taken our buy the moment price hit the fair value gap, you will notice that we would have had a very wide stop loss like that in order for price not to hit us out, right? But now, since we are doing it now on the lower time frame, we could have had our stops now safe below this low. But now this low is not the low that we had on the higher time frame. The low was right down here. So which means for us to have been safe on that higher time frame, our stops were supposed to be down here, right? Because we don't know how deep this price is going to be into this price range. Remember, this is the price range that we had on the weekly. This is the price range. This is the range high and this is the range low. And we had their fair value gap there also retesting this point. But you don't know if this price is going to trade right down to the discount or not. So which means a safe place for you to put your stop loss should have been down here. But no, we don't have that luxury to put some that to be our stop loss. The reason why we are dropping to a more lower time frame to wait for confirmation, this downtrend should now shift to an uptrend, and they will wait for a pullback, and they will get our longs from there. The difference now is we use the higher time frame as a key level. Lower time frame, we use the same FVG now as an entry. Let's try to look at this other one. I think this was another zone here. Okay, this was another one. Right, so price came into the FVG. We have to wait for price to shift market structure to the bullish side. Right, at this point, we did not get any clear close above. That was still a stop hunt, and then price finally did another stop hunt below. Now, at this point, we noticed that there is we had this FVG here. Okay, we had this one. Now, we actually don't have a clear break of structure as of this point, unless maybe you go down to a little lower time frame to get that structure. But now, just based on total SOAP in a key level, would have been going long from that point, right? From this FVG. If I'm just talking about FVGs here, we are not talking about that blocks. Would have been taking now a vibe here, using this fair value gap now as an entry, not as a key level anymore. And then we are now targeting higher prices. All right, that is how it would have been different. Now we had another FVG here, and then which is as a key level. What do? We know that we're having a downtrend into that fair value gap. So what do we do here? We wait for a shift in market structure. All right. Now we're using this FVG now as an entry. You will ask me that, okay, why did price not come down to this fair value gap? Okay, because I think maybe somebody would have been waiting for price to come down to this FVG before he buys, and the price did not. What can we do about it? That leads us to the next lesson, which we are going to talk about breaker blocks. All right, breaker blocks, sometimes they're going to stop price from pushing lower. Okay, that's the situation where you have price pushing higher, and then it creates a breaker block, and then it comes respect the breaker to continue higher, leaving even your bullish other block here plus your fair value gap. Okay, we're going to talk about breaker blocks, and then you understand the reason why sometimes you're going to have fair value gaps aligning with that. Price will respect it rather than coming lower. But for me personally, always to be safe, when I take a trade, wherever I take it, I always make sure that I put my stops at a swing low. Okay, because sometimes price might still invalidate the breaker to come right down to the other block here, which actually was aligning with the fair value gap here. So for me to be safe, I'll prefer that. Now there's another trick that you can use. You can decide to take the trick here with 0.5 with 50% risk, and then you take the other one here with 50% risk. Okay, it's still going to save you the same purpose, because if you're not sure if price is going to reverse from here, what you're going to do is, if you wanted to risk $100 on the trade, you risk $50 here, and then you risk $50 here. Okay, this is going to be much easier for you, so that if this is playing out good, you are not going to miss out. But if all of them want to play out, still you are not going to miss out. All right, so it's and if all of them hit stop loss, then you are still going home with your minus 100 as you wanted to risk from the start. So I believe we have talked a lot about that already. So I would love to hear your questions if you have them, so that we have just about 3 minutes to end the session. So I'm going to stop recording and then I'll answer your questions.